Champagne corks are going to be popping on both sides of the Atlantic this week after Bayer sealed a $66 billion takeover of Monsanto. That marks the single largest takeover deal of the year so far. And particularly pleased are obviously going to be the company's investment bankers, who have been struggling with a pronounced slowdown in deal making this year. So after a long M&A boom, where global deal volumes have almost doubled between 2010 and 2015, fee revenues for advisors actually fell in the first half by 15% compared to the year before. So mergers and acquisitions, as any banker will tell you, are very, very sensitive to the wider market, and as such can actually provide a useful proxy for bearish investors who want to bet that interest rates going up and political uncertainty could destroy future M&A activity. So those who've sought to profit from the current uncomfortable situation rainmakers might find themselves in have actually only been partially rewarded. The shares in big investment banks like Goldman Sachs are down 7% since the start of January, while Morgan Stanley stock is actually more or less flat. So the key for anyone betting on a slowdown in investment banking revenues is to actually seek out the listed banks which are most exposed to lower M&A volumes, the smaller boutiques that rely almost entirely on lumpy revenue from mergers and acquisitions to stay profitable. And so these boutiques, which include Evercore, Moelis, Greenhill, to name a couple of them, they retain and reward their bankers by paying bonuses mostly in stock. And that means that the stability of the business is intimately linked to their share price. Greenhill appears particularly vulnerable to a kind of dangerous feedback loop caused by falling M&A activity. During the 5-year boom in deal volumes, Greenhill's revenues actually remained flat, which indicate that it has failed to increase its market share when times were good. It also spent at the same time $250 million on share buybacks between 2011 and 2015, but its overall share count rose over that period, owing to the large amount of stock that it has to constantly issue its staff to retain them. So as M&A activity has dipped, Greenhill shares have similarly suffered, meaning that the value of the bonuses they gave to their bankers in stock has gone down. So to retain those bankers, it's going to have to issue yet more shares, diluting existing shareholders even more. But if M&A volumes fall, it will lack the revenues to balance this by buying back stock. So if Bayer Monsanto marks the top of the most recent M&A boom, then some of these boutiques may find themselves locked into an unfortunate catch-22.